Something unprecedented is happening in the global gold market right now, and if you're not paying attention, you could miss one of the most significant wealth transfers in modern history. The vaults are draining. Not slowly, not gradually. We're talking about a systematic depletion of physical gold from the world's most important storage facilities at a pace that's making even seasoned market veterans nervous. Let me show you what's really going on behind the scenes, because the mainstream financial media isn't telling you the full story. They can't, or maybe they won't. Either way, you need to understand what's happening before it's too late. The London Bullion Market Association, the LBMA, is the epicenter of the global gold trade. This isn't some small regional exchange. We're talking about the institution that facilitates the majority of physical gold transactions worldwide. The gold that backs ETFs, the gold that central banks trade, the gold that underpins the entire paper gold market. It all flows through London. And right now, something's breaking. Gold lease rates have spiked to levels we haven't seen in years. Now, if you're not familiar with lease rates, let me explain why this matters. When lease rates surge, it means there's a shortage of physical metal available for immediate delivery. Banks and institutions that need physical gold are willing to pay premium rates to borrow it because they can't get it any other way. Think about that for a second. In a market that's supposed to have abundant supply, where paper contracts trade by the millions of ounces every single day, suddenly there's not enough physical metal to go around. The spreads between paper gold and physical gold have widened dramatically. This is the canary in the coal mine. When you can buy a paper contract for gold at one price, but the actual physical metal costs significantly more, that tells you something fundamental is broken in the pricing mechanism. Here's what's actually happening, and this is where it gets really interesting. Physical gold is moving from London vaults to COMEX vaults in New York at an accelerating rate. But here's the thing, it's not just moving, it's disappearing from the available supply. Once it lands in COMEX, much of it gets immediately claimed for delivery and vanishes into private hands, central bank reserves, or sovereign wealth funds. The COMEX itself has seen its registered gold inventory, that's the gold available for delivery against futures contracts, drop to levels that would have been unthinkable just a few years ago. We're talking about inventory levels that represent just a tiny fraction of the open interest in gold futures. Let me put this in perspective. Imagine a casino where 1,000 people are holding chips, but when they all try to cash out at once, the casino only has enough money to pay 10 of them. That's essentially what's happening in the paper gold market right now. The ratio of paper claims to physical gold has reached absurd levels. Some estimates put it at over 100 paper ounces for every single ounce of physical gold that actually exists in deliverable form. This is a system built on confidence, on the assumption that not everyone will ask for their gold at the same time. But what happens when that confidence breaks? We're starting to see the answer. Delivery delays that were once measured in days are now measured in weeks or months. Premiums for physical gold over spot prices have exploded in certain markets. In some Asian markets, buyers are paying 5, 10, even 15% over the spot price just to get their hands on physical metal. Central banks know something. They've been net buyers of gold for over a decade now, but the pace has accelerated dramatically. We're not talking about small purchases. We're talking about hundreds of tons being accumulated by countries that understand what's coming. China's been particularly aggressive. Their official reserves show steady accumulation, but many analysts believe their actual holdings are far higher than reported. They've been building a gold infrastructure, refining capacity, storage facilities, trading platforms that suggest they're preparing for a monetary system where gold plays a much larger role. Russia, despite sanctions, despite being cut off from Western financial systems, has continued accumulating gold. In fact, being cut off from SWIFT and Western banking probably accelerated their gold accumulation strategy. When you can't trust the dollar-based system, when your foreign reserves can be frozen with the stroke of a pen, gold becomes not just an investment, but a necessity. The BRICS nations, Brazil, Russia, India, China, South Africa, and now expanding to include others, have been openly discussing gold-backed trade settlements. This isn't conspiracy theory. These are official policy discussions happening at the highest levels of government. What does this mean for the average person? What does it mean for your retirement savings, your purchasing power, your financial security? Let's think about this logically. If the physical gold market is this tight, if vaults are being drained, if central banks are scrambling to accumulate, what happens to the price when the paper market finally breaks? Because it will break. It has to. You cannot have 100 paper claims on every ounce of physical gold indefinitely. At some point, someone's going to stand up and say, I want my gold, and there won't be any gold to give them. When that happens, when confidence in the paper gold market evaporates, the price discovery mechanism will shift entirely to the physical market. And in a physical market with genuine scarcity, with central banks competing against institutional investors competing against wealthy individuals. The price could go to levels that seem unimaginable right now. We've seen this movie before. In the 1970s, gold went from $35 an ounce to over $800 in less than a decade. That's not a 20% gain or a 50% gain. That's a 20-fold increase. And that was in a world where central banks weren't printing money at anywhere near the pace they are today. The money supply has exploded. Since the financial crisis, and especially since the pandemic response, central banks have created more currency in a few years than existed in all of human history before. That's not hyperbole. That's mathematical fact. And what backs all that currency? Confidence, trust, the belief that governments and central banks will maintain the value of their money. But what happens when that confidence wavers? What happens when people start questioning whether their dollars, their euros, their yen will hold their value? They look for alternatives. And throughout all of human history, across every civilization, every culture, every economic system, gold has been that alternative. Gold doesn't have counterparty risk. It can't be printed. It can't be created out of thin air. It can't be devalued by a central bank decision. It simply exists, with all the properties that have made it valuable for thousands of years. The current system, the system where paper contracts trade at prices disconnected from physical reality, where leverage and derivatives create the illusion of abundant supply, that system is showing cracks. Those cracks are widening. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the process actually works, what the costs are, all the details you need to know. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in these vaults. The mechanics of the gold market are complex, deliberately so. There are multiple layers of intermediaries, multiple types of gold ownership, multiple ways to claim exposure to gold without ever touching physical metal. You've got allocated gold, where specific bars are assigned to you. You've got unallocated gold, where you have a claim on gold but not specific bars. You've got ETFs that supposedly hold gold. You've got futures contracts. You've got options on futures. You've got synthetic exposure through various derivatives. Each layer adds complexity. Each layer adds leverage. Each layer moves the market further away from the underlying physical reality. And at the bottom of this inverted pyramid, supporting all these paper claims, all this leverage, all this complexity, is a relatively small amount of physical gold sitting in vaults. What we're seeing now is a stress test of this system, and it's not passing. The bullion banks, the major institutions that make markets in gold, are facing unprecedented pressure. They're caught between clients demanding physical delivery and a physical market that can't supply metal fast enough. Some of these banks have been in the gold business for centuries. They've weathered world wars, depressions, financial crises, but they've never faced a situation quite like this, where the entire structure of the paper gold market is being questioned simultaneously by central banks, institutional investors, and increasingly retail investors who understand what's happening. The premiums on physical gold coins and bars have been elevated for years now. You go to buy an American Eagle or a Canadian Maple Leaf, and you're paying significantly over the spot price. That premium represents the real supply and demand dynamic in the physical market. But here's what's interesting. Those premiums have been persistent. They haven't come down. In a normal market, high premiums would incentivize more supply, more minting, more production, and premiums would normalize. That's not happening. Which tells you the supply constraints are real and ongoing. Mining production has been relatively flat. Despite higher gold prices, despite massive investment in exploration and development, the amount of new gold coming out of the ground each year hasn't increased significantly. Why? Because the easy gold has been found. The high-grade deposits have been mined. What's left requires more energy, more capital, more time to extract. And even then, it takes 7 to 10 years to bring a new mine into production. So supply is constrained. Demand is surging. And the paper market that's supposed to provide price discovery is showing signs of severe stress. This is the setup for a price move that could dwarf anything we've seen before. Think about the forces at play. You've got central banks that have printed unprecedented amounts of currency, and now need to back that currency with something real. You've got geopolitical tensions that are driving countries to reduce their dependence on the dollar. You've got inflation that's eroding purchasing power and driving people to seek stores of value. You've got a generation of investors who've watched their savings lose value in real terms despite rising stock markets. All of these forces point in one direction, toward gold, but not paper gold. not ETF shares, not futures contracts, physical gold, the kind you can hold, the kind that doesn't depend on a counterparty's promise, the kind that's been money for 5,000 years. And there's not enough of it to go around. The vaults are draining because smart money understands this. They're not waiting for the mainstream media to tell them it's time to buy gold. They're not waiting for their financial advisor to recommend it. They're acting now, while physical metal is still available at anything close to reasonable prices. Because once the paper market breaks, once the disconnect between paper prices and physical prices becomes undeniable, the scramble for physical gold will make current premiums look quaint. Imagine trying to buy gold when everyone else is trying to buy gold at the same time. When central banks are competing with billionaires, competing with pension funds, competing with sovereign wealth funds. When the price is moving up, not by dollars, but by hundreds of dollars per day. That's not fear-mongering. That's basic supply and demand in a market where supply is fixed and demand is exponential. We saw a preview of this during the pandemic. When lockdowns hit, when mints shut down, when supply chains broke, physical gold became nearly impossible to buy at any price. Premiums went to 30, 40, even 50% over spot in some cases. And that was just a temporary supply disruption. What we're facing now is not temporary. This is a structural shift in the global monetary system. This is the unwinding of 50 years of pure fiat currency. This is the market rediscovering what money actually is. Gold has no yield. That's what the critics say. It just sits there. It doesn't pay dividends. It doesn't generate cash flow. But that's exactly the point. Gold doesn't need to generate yield because gold is the yield. It's the final settlement. It's the asset that has no counterparty risk, no default risk, no political risk. In a world where government bonds yield less than inflation, where stocks are valued at historically extreme multiples, where real estate prices have been inflated by decades of low interest rates, where does capital go to preserve itself? It goes to the one asset that can't be inflated away, the one asset that every central bank in the world holds, the one asset that has survived every currency collapse, every empire's fall, every financial crisis in human history. The smart money isn't asking whether gold will go higher. They're asking how much higher and how fast, and they're positioning accordingly. The vault drainage we're seeing is not random. It's not coincidental. It's the visible manifestation of a massive coordinated shift in how sophisticated investors view risk and value. They're looking at a financial system built on debt, leverage, and monetary expansion, and they're saying, I want out. I want something real. I want something that can't be manipulated by central bank policy or political decisions. They want gold, and they're willing to pay up to get it. They're willing to wait for delivery. They're willing to deal with the logistics and storage costs and all the inconveniences of physical metal, because they understand that those inconveniences are nothing compared to the risk of being caught holding paper promises when the music stops. The gold market is sending signals right now that are impossible to ignore if you know what to look for. Elevated lease rates, widening spreads, delivery delays, vault drainage, central bank accumulation. These aren't isolated incidents. They're all pieces of the same puzzle. And that puzzle, when you step back and look at the complete picture, shows a market that's fundamentally broken at the structural level. The paper gold market was designed to provide liquidity, to allow hedging, to facilitate price discovery. But it's evolved into something else entirely. It's become a mechanism for price suppression, for creating the illusion of abundant supply, for allowing leverage that has no basis in physical reality. That mechanism is failing. You can see it in the data. You can see it in the behavior of major market participants. You can see it in the increasing desperation of bullion banks trying to source physical metal. The question isn't whether this system will break. The question is when and what happens to the price of gold when it does. History provides some clues. Every time a paper currency system has collapsed, every time confidence in fiat money has evaporated, gold has reasserted itself as real money. Not sometimes, every single time. The Roman denarius was debased until it was worthless. Gold survived. The assignats of revolutionary France became toilet paper. Gold survived. The Weimar Republic printed until their currency was literally worthless. Gold survived. The Zimbabwe dollar, the Venezuelan bolivar, the Argentine peso, every hyperinflation in history has ended the same way. The paper money dies. Gold survives. We're not necessarily heading for hyperinflation, though that's certainly possible. But we are heading for a repricing of gold relative to fiat currencies. A significant repricing. A repricing that reflects the true scarcity of physical metal and the true abundance of paper currency. When that repricing happens, When the market finally acknowledges that there's not enough physical gold to satisfy all the paper claims, the move will be swift and dramatic. The people who position themselves before that move will preserve and likely multiply their wealth. The people who wait, who assume they can always buy gold later, who trust that the current system will continue indefinitely, they're taking a risk that may not be apparent until it's too late. The vaults are draining. The physical market is tight. The paper market is stressed. Central banks are accumulating. Geopolitical tensions are rising. Currency creation continues unabated. Every single indicator points in the same direction. The gold market is telling us something. It's screaming at us, actually. But most people aren't listening. They're distracted by stock market rallies, by cryptocurrency hype, by whatever the financial media is promoting this week. Meanwhile, the smart money is quietly accumulating physical gold. They're not making noise about it. They're not bragging on social media. They're just steadily, methodically converting paper wealth into physical metal, because they know what's coming. They know that in a world of infinite paper currency and finite physical gold, the math only works one way. The price has to adjust. Dramatically. The only question is whether you'll be positioned correctly when it does. The vault drainage isn't a conspiracy theory. It's documented fact. The lease rate spikes aren't speculation. They're observable market data. The delivery delays aren't rumors. They're experienced by anyone trying to take physical delivery of size. This is happening. Right now. In real time. And the implications for your wealth, for your financial security, for your ability to preserve purchasing power through what's coming, those implications are profound. Gold isn't just an investment. It's insurance. It's a hedge against monetary chaos. It's a store of value that has worked for thousands of years and will continue working long after today's fiat currencies are forgotten. The vaults are draining because people who understand money, who understand history, who understand the mathematics of the current system, they're voting with their capital. They're choosing gold. The question is, will you?